All right. We're going to give people a few seconds to hop on here and join us. Got an interesting conversation today. We're going to be talking about the Canadian real estate market. Obviously, lots of stuff going on and lots of things to talk about. And we've got the Noex back with me this week. So this is going to be something different, something a little new, a little live, little conversation. We don't know what's going to happen, but if you're joining us and you want to put questions in the comments section, you're more than happy to do that, and we'll answer them as they come up. And yeah, people who get engaged get prizes. So make sure you're asking questions and in the comments section. And without further ado, I'm going to bring on the Noex, get them in the chat here, and see where things go. Welcome back, guys. It's been a while since we've done one of these.
It has.
Yeah, been what? 2 or 3 months. Things got busy in the summer.
Something like that, you know. I think about I'd say 2 months.
Yeah.
Well, lots of changes in the family. I'm the youngest one. He's the oldest one. No, I'm just kidding. But the youngest one had a new addition to the family, a new baby, which is kind of cool. And I did get a new Robert Graham shirt for the event, so I just want to let you know that.
Is that the blue one you're wearing right now? Because nice.
Yes. Oh, that's that cool one that all the guys in Vegas with the pretty young girls wear, right?
Yeah.
Is that what it is?
Is that what happens? I better take it off.
Yeah. It's the same sort of guy that will wear a sports jacket and a t-shirt too.
Oh man, I'll tell you.
Isn't that everyone? Is that not cool anymore, Miles?
I don't know. It's coming back, but for a while there, it was definitely the guy in Vegas who's there, you know, with a woman that's not his wife. What?
Holy smokes. Well, the reason why I wear these shirts, because on it says wisdom, knowledge, and truth. So, you know, I've got at least one of those, so that's good.
The truth part, hey?
Yeah, exactly.
Speaking of the truth, what's going on? How's the market out in your guys' area right now? Things slowing down?
Slowing down a bit on the real estate side. Yeah, I'd say it's cooling off a bit, but it's still going, trucking along, just a bit slower.
It's funny because interest rates have scared the crap out of people, and you know, these are the highest rates we've seen in a long time, and of course prices. But we still got people buying houses and refinancing and doing stuff. So
lots of refinances and lots of equity takeouts, lines of credit, stuff like that. But it's funny because everyone for so long wanted the house prices to go down. They wanted rates to go up to lower the house prices, but then rates went up and the prices didn't really go down that far out here. I know they've gone down in other areas of Canada more, but hasn't really had a huge effect out here.
We're going to dig into that because definitely it's different based on the market that you're in.
Oh, totally.
And we're going to get into delinquencies. We're going to get into people choosing different types of lenders, which you guys know a lot about with your mix. We're going to talk about arrears. We're going to talk about a whole bunch of things that's really pertinent to the Canadian market. But I think the thing right now is, and you guys hit it dead on the head, is there's a lot of fear out there, and it doesn't seem like the fear is getting any better. What do you guys think?
It's funny because, you know, I mean, we live in this little pocket area where migration is our biggest friend, right? So we have lots and lots of people that are selling in the Lower Mainland and moving to Vancouver Island because it's affordable still. And we've seen prices stabilize. But I think, people, you know, I mean, it's funny. We've had so many calls in the last couple of weeks where people have said, hey, listen, I did a 3% mortgage 54 months ago. It's up in August. What is going to happen? And you start going through some ideas, and you know, I've been doing this a long time, 32 years, and so we've seen some cycles before, not quite where we've had interest rates go up so high and the house prices go up so high too, but you know, where people have said, you know, my payments used to be $2,400 a month, and they're wondering what the heck our payments are going to be. So we're getting lots of those questions right now, which is really cool.
This is totally in the weeds, but did you just say 32 years?
Yeah.
Because you know you've been doing this since the day I was born, right?
No.
And how old am I?
I'd have to go to my emails to find out. You're 33.
You've been doing it 34 years, my friend.
I'm older than
take my shots when I can get them.
Too funny.
34 years. And that's the funny thing too. I mean, it's the nice thing about working with my dad, right? Because I've only been doing this in about 12, 13 years. He's been doing it over 30 years. He's seen these cycles. He's seen what's happened. So, I mean, when you pair that up and that knowledge and what we've seen in the past to what's going on now, Yeah, things are a little spooky, but there's ways to get through it. There's still, if you want to buy a house, you should still buy a house. And we're going to see times like this again. It's not like it's going to happen once and never happen again. We're going to see rates go up. We're going to see them go down. We're going to see them go up again and then down again. It's a big circle.
Yeah. The question is it new normal, or is it,
Yeah.
or are we going back to where we were a couple of years ago? There's some really interesting articles this week, and we'll touch on those at the end. But some different predictions from different economists on what's going to happen with rates. And I like really optimistic predictions, which I'll let you guys chime in on that here at the end. But let's get into it. Let's take a look at some of the things that's going on in the industry here. And I'm gonna start with this one right now, because this is really interesting. Okay, so Scotiabank profits fall as the bank sets aside $1.3 billion to cover bad loans. So $1.3 billion to cover bad loans. This is significantly higher than any of the other banks. And what's interesting about this is that they've the profits are affected by how much they set aside for bad losses. So in other words, if they set more aside for bad losses, their profits go down. It's a direct trade-off. And Scotiabank has set aside significantly more than Canada's biggest bank, RBC. And RBC this week, at the same time that Scotiabank announces falling profits, TD and RBC both announced higher profits and increases to dividends, but didn't set aside as much for loan losses, which I find really interesting, because variable interest rates with fixed payments have the single highest exposure for loan losses, in my opinion. Scotiabank doesn't have those.
No,
What do you guys
they're
make of this?
adjustable.
Exactly. So
It's
got
super weird.
it, why would Canada's biggest bank set aside less for loan losses and increase dividends at a time when it seems like there could be more loan losses? What's going on here?
Do you think that people are still, I don't know. I think that people over the last 2 years, it's funny, we're just talking about doing budgets again, where you sit down and figure where the hell your money goes every month. And, to dummy it up, Cindy and I sat down last month and took our last 12 months bank statements and Visa statements and went, holy crap, this is what we're spending money on the last year versus 2 years before through COVID. So we've seen lots of people that all of a sudden they're spending, they're right here. They're right at the very top. They don't have much left over. And where, through the beginning, just the start of COVID, people were saving dough, and now they're not anymore because they're spending it on everything else. So I think that I think people have either one of two attitudes. They either are saying, we're going to be okay, and we just have to tighten up our purse strings and push things out a little bit. And we know that in the next 24 to 36 months, things will be okay again. And then you get the other end of the spectrum where I think people are watching this press and going, holy crap, Scotiabank's putting $1.3 billion off to the side for bad loans. What the heck is going on here? So
I think it's interesting too, because like for the last little bit, Scotiabank, their rates and stuff like that have been very different from a lot of other lenders. I know, for example, like with just the way we've been dealing with it, if you look TD Bank versus Scotiabank when it comes to rate, TD Bank was better for probably this entire year. So the other thing too that I look at with that is, in my thought process, is TD Bank's probably doing more business with mortgages than Scotiabank, but they're also tucking aside more, which just it's weird.
Makes me wonder if there's something going on within Scotiabank in their loan book that maybe the rest of the industry can't see.
Yeah.
But to me, I just don't get it. I think banks raising dividends in times where it's obvious that prices or that their profits are probably going to go down in the next little while, and they're raising dividends. Like, to me, that's almost like they're putting more expectation in the fact that they need to, or they're putting more weight on the fact that they need to increase shareholder confidence than they are deal with the realities of what the next couple of years look like, right?
Yeah. Very true.
Or they just have better economists and they think that everything's going to be good for the next little while, and there's no problems on the horizon. Who knows? But so check this out. I got to show you these. So you guys know Jordan Skrinko, our buddy pre-condo. We've had him on the show before. I got to show you these videos. So he released a series of 3 or 4 videos. He's gotten almost 1 million views in the last 30 days. He's
Wow.
easily the most watched YouTuber in the Canadian real estate space right now. He at least in the fourth quarter, he definitely took that title away from me. But really interesting stuff happening in the Toronto market. So Toronto developers are going bankrupt is the first one here. This was the big one. Toronto foreclosures up 400%. Now this title is clickbait from the perspective of it makes you want to click it, not from the perspective of it's a lie. What was interesting about this was at the time he posted this video, there was about 150 foreclosures in the Toronto market. Now that was up 400%, but relatively speaking, it was still a pretty low number of foreclosures at 150.
Yeah.
And then what's interesting is you go into the Kelowna market. This is one of my YouTube consulting clients. And he did a video very similar, looked at the numbers, found out Kelowna foreclosures were up 363%. I don't know what the exact number was, but nominally it was low. But in general, there's a lot more foreclosures than there were, let's say, a year ago. But historically speaking, these numbers aren't actually that high. But where it
Yeah.
seems like the majority of the foreclosures are coming in is with small non-bank lenders, similar to Mix or private lenders that are forcing their clients into foreclosure situations primarily because they want the money back. Is this something that you guys are seeing or
Not as much. I mean, I know I have a family member who works for a lawyer, and me and him were chatting about foreclosures, and he was saying he's seen more of them than normal. But I mean, when you look at foreclosures too, and like to say like 400%, 300%, if you have one and now you have four, I mean, it's not like we're talking about huge amounts of foreclosures, like you just said. I think it's a lot of doom and gloom, in my opinion. And I think, if people can sort of take advice on how to avoid foreclosure instead of being afraid of it, I think you're going to see a lot better things happen for a lot of people.
You think
And
of
it's just, yeah, I don't think we see a lot of it. I mean, I don't think I've had a single client phone me going, "Oh my God, they're going to take my house." Like, I just haven't.
Yeah, 1981, 1989, 2001,
Yeah.
2008. Holy crap! And is that something? 2008 United States. Is that something that some of our charter banks are worried about? I don't think so because our banking is completely different. But in the same respect, I can speak for us in that I'm a director in a small MIC on Vancouver Island where out of 65 loans, we may have a couple a month that are delinquent, which the numbers are phenomenal, which tells us that we're a little too tight on our underwriting. But also on a foreclosure perspective, in most mix, their blended loan to value ratios are like 54% right now. So,
Yeah.
and for us, we don't have a whole pile of foreclosures at all. We've got 2 files I think we're working on where we're trying to get things organized, and it's because of unforeseen circumstances. So I just don't see a whole pile of that happening. And like I say, when you're below 10%, like, yeah, look at that, holy crap.
Yeah.
Like, I mean, boy, what a great place to invest.
yeah. Well, what I find interesting is this is if you look at the non-bank lenders and you look at the mortgage investment entities, which is referring to Mix and private lenders, the new market share is actually up in those two areas
It
as
is, yeah.
opposed to the big 6 banks is down. So what that tells me is that there's a lot of people out there getting mortgages that don't qualify under the
Yeah.
traditional guidelines. And my guess is that companies like the ones that you guys have would be seeing some of this. And are you seeing more people coming to you guys? Like, is the volume in the MIC up relative to how much down the volume is in the business that you're sending to big 6 banks?
Yeah, we're getting lots of files. I think most of the mix are getting lots of files because of the qualifying. You're right, because of the stress test and how things have been affected by that. So, and people are just tired of waiting. Like, you can send a file into a financial institution, which is sort of on the edge, and you can wait 60 days where you can get it done through an alternative lender fairly quick. Now, of course, the rules are going to change for these guys as well coming next year. So, because you don't have to take as much documentation, but in the same respect, you still have to underwrite the file, right? So, but the alternative lenders have seen more and more and more, and those are the guys that are picking up a lot of the
That's what I was going to say is we haven't seen as much private, but we've seen a lot more alt Alt A lenders, Alt B lenders, just like, more unique stuff. Like you got the guy who's self-employed and you do stated income program, stuff like that. But when it comes to like strictly private,
Not so much.
not so much, no. And it's I mean, the thing behind it too is that it's I know a lot of people, especially when you talk about private lenders, get scared, right? Private mix, ooh, scary. Um, they're there for a reason. They are, and if you use it appropriately and use it properly, it can be a tool that can get you out of a lot of trouble and get you back on track to being back with an A lender or back to being normality, right? Like, I mean, we just went through a pandemic. We just went through a whole bunch of high inflation and all this sort of stuff. And a lot of people, I mean, if you look at consumer debt, it's through the roof. And there are people who are now going, oh my gosh, I can't afford my consumer debt, but I've got equity in my house. If I take this private mortgage to maybe lower my payments because of those other debts, is that an opportunity as long as I stay on top of that? And then I refinance once I get my credit back up, once I get more qualifying in and stuff like that. It's I can see the reason for the increase. I think people just need to be smart with how they get it. Looking at a private lender, it's not free money and it's not a traditional mortgage. It's more expensive, it's more costly. It's there for a reason. And if you're going to use it, you got to use it right, because if you use it wrong, it can really create some issues.
Yeah, no, you're definitely right. I kind of look at this number here. Have you guys seen this from the recent CMHC report?
Yeah.
Where we're starting to see some delinquencies,
Mm-hmm.
number of 90 days or greater, 90 days missed payments or greater. What's interesting to me is that this is happening with mortgages that are $850,000 or more first. Normally, you kind of see the little guy getting squeezed, especially in a recession. We aren't really in a recession yet.
Yeah.
I mean, you could argue that technically we are, but you'd typically expect the lower income earners to get squeezed first. What's interesting right now is that it's the higher income earners and the higher mortgage holders that are getting squeezed. You see that $850,000 and up
Yeah.
section kind of going up. Now, this has happened in the past. It happened in 2019. It happened early in the pandemic. But that kind of tells me that the people that got the really big mortgages are the first ones that aren't really able to afford it. And
Well, and how many of those people are on adjustable payment variables, right? Which, don't get me wrong, I think that's the way to go versus the static payment. I personally am not a big fan of the static payment, but I mean, we saw house prices go up dramatically. We saw really like a lot of accessibility to mortgage credit with low rates and stuff like that. I mean, yes, we have the stress test. You qualify at, what was it, 5.25%, but you're getting like 1.89, 2.5%. Like, it just made all the sense in the world. And now in a short period of time, we've gone to a point where those rates are significantly higher. I mean, I think there was a lot of people who weren't necessarily high income earners that were still able to take out those larger loans on that stress test rate, which now we've surpassed that with the way rates are. And now they're starting to feel that pinch.
now,
Maybe just a little bit of over leveraging.
do you think that maybe this is why Scotiabank's increasing their loan loss provisions, is because they're seeing something that the rest of the industry isn't, because they have full on adjustable payment mortgages?
Well, they also have extended servicing ratios.
What
Good
does that
point.
mean?
You can borrow more from Scotiabank than you can from First National.
Yeah.
Right?
But
Like
not the
First
bank.
National, you're limited to 39% of your annual income for your principal, interest, taxes, and heat.
Yeah.
But with Scotiabank, for strong clients, 20% down, good income, good credit, they'll push you further. But I think all the charter banks will do that. I'm pretty sure TD will do that, Scotiabank, RBC.
But there's still this big difference between what Scotia's doing on their loan loss provisions and what the
Yeah.
other banks are doing. Like, why? And is it they're seeing something with the adjustable payments? Maybe, but I don't
Yeah.
think that the extended ratios, the ability to borrow more at Scotiabank, is any different than what the abilities of RBC or TD. In fact,
Yeah,
I would
that's
probably argue that based on what I see and based on the mortgages that we see getting done at lenders where they probably shouldn't be getting done, Scotiabank would be the one that I think has the least exposure to the extended
Yeah.
ratios versus
I think you're right.
I
so,
agree.
I mean, to
Yeah,
me,
I
in
think
my
you're right.
mind, from what I see in the industry, I almost feel like RBC should have the highest loan loss provisions. One, because they have the biggest book, but one, because from what I can tell, they do the riskiest lending when it
They
comes
do,
to
100%.
clients, right?
Did we? And there's no comments from our usual phenomenal favorite economist from CIBC.
Benjamin Tell.
Yeah, like he's always been pretty spot on with a lot of his a lot of his information and predictions. So I always find that he's a good go-to person. I wanted to bring in one point though. We talked about the recession, potential recession. When was the last time you were in a Starbucks lineup or a Tim Hortons lineup or a Cactus Club on a Tuesday and try to get in there? Like, what recession? Like, holy crap! Like, everybody's spending all their money. What's going on right now? Like, it's crazy.
I'll tell you what, though, the Starbucks thing can be tricky because in 2008, in the middle of the crisis, I was in the US and I went to a Starbucks and literally I was standing in a 30-person lineup and there was a bunch of construction workers in that line. And I saw that, and this was like mid-crisis. I saw that and I went and invested a whole ton of money in Starbucks because I'm like, if they're not going to give up their habit, this is a pretty sticky business. And I did pretty well off of that investment. The other one I did was Amex at the time, and I bought Ford because Ford got down to $6, which was freaking insane. I
That's
bought all
super
those
low.
stocks, but I remember that distinctly. Like, people don't give up their Starbucks, man. They don't mess with it.
Oh, people will die for Starbucks.
Yeah, that's not a
Like,
recession indicator. It's when people
yeah.
stop going to like Louis Vuitton or what. I don't even know if that's a recession indicator, but there's
I
an
think if
interesting thing I noticed. I notice every time there's a recession, there's a steakhouse in Calgary. It's a national steakhouse. And it's the most expensive steakhouse in the city. Every single time there's a recession, they jack their prices by 30%. And
Yeah,
it turns out that the reason that they do that is because the people who can afford it will
still
not
they're
go.
only
still gonna
continue
go.
to come, but they'll pay 30% more. Their
Yeah.
profit margins stay the same, their revenues stay the same,
Less people.
and they just have less people. So
Yeah.
Yeah.
it's interesting. But I do agree with you. People are still spending money way too
Oh,
fast, and we
totally.
haven't hit the point where that's going to change.
But I think the big ticket items have changed. Like, we're in, through COVID when people were buying boats and cars, like they were,
Boats,
like they were
cars,
half allowed to do
trailers.
anything. Now all of a sudden we're seeing lots of big changes with that.
Yeah.
I also think it matters where you live too. I mean, this is from Edge. What is it called? Now I can't remember. It's called Edge Analytics. It's Ben Robideau, I think is how you say his last name. He puts out an amazing report every month. You pay like $35. If you're a realtor, if you're in the industry, you have to have access to this report because it is so detailed and it's so good. But this is one of his slides. And this is clearly information that you can get from outside of there as well. But if you take a look at mortgage delinquency rates, those numbers are largely in Ontario. And you look to other provinces like Alberta, and I'm guessing if you look to more specific areas like the area you're in Vancouver or Vancouver Island, I should say, it depends where you live. Like, delinquencies
Yeah.
aren't high everywhere, right? Certain
No.
markets it's turning. And I think the trend is where there was extremely quick run-ups in values and chaos in the markets are the markets where there's the highest amount of delinquencies. And Nicholas Baker, sorry, put in a comment. He said, delinquency due to people that overextended themselves and lied to qualify for a mortgage. Well, I think he's probably right. There's probably a lot of these delinquencies are from people who did fraud for housing and maybe fudged the numbers on how much they could afford, or maybe got a cosigner or something like that. I mean, what do you guys make of this?
Well, I think too that I mean, we brought it up. You brought it up earlier, where there's files that we haven't been able to do that the big six can do, right?
Yep.
So all of a sudden, what's happening here? Like, we have situations where we'll send a file to their own institution just to make sure that we do the right thing, and sometimes they do them, and we don't think they should. So
It's it's interesting because
It's
eventually,
weird.
every once in a while, I mean, at least one a year, you're gonna get that file where it's like, yeah, no, sorry, you don't qualify for what you want. And because we're such nice people and we're mortgage, it's because we're business people. We keep in touch with people constantly. So you're keeping in touch with that person, and they get that email saying, "Hey, just wanted to check in and see how things are going with you. Maybe we should update that app." And they go, "Oh, sorry, no, I got approved through RBC or CIBC." And you're looking at the numbers, and anytime this happens, the first person I phone is my dad, and I'm like, "How is that? Like, no, that shouldn't have happened," because it's true. I mean, I always say this to clients. Like, if I've got a customer who's looking, going, "Oh yeah, I'm going to get an $800,000 mortgage to buy this $1 million house and all this sort of stuff," my first question to them is, "Okay, if you qualify for this, should you actually take it? Should you take that mortgage? Should you take that payment on?" Because when you buy a house, I think a lot of people were looking at houses as real quick turnaround things, right? Like, oh, I'm going to buy a house, I'm going to sell it in 2 years and make 500 grand or whatever. Well, when you think that way, that's where you can get caught with these sort of nasty scenarios, because yes, you do qualify for it, but look at the payments. Can you afford those with your lifestyle? Or are you able to make changes if all of a sudden those payments increase? And I think a lot of people just sidetracked that, shoved it off, and didn't care about it. Oh, someone's trying to break into Greg's house. That's his alarm system.
That's my.
Oh, we can deal with that real fast. Oops. I don't know what he said, but the
Nice.
mysteries of what yeah, that's exactly
It's okay.
it.
I'm waiting for the baby to start crying in the back. His bedroom is literally on the other side of this wall. And he is just shy of 2 months old. So sleeping, forget about it. He
He's
does not
optimal.
want to do that, but he's tired, of course. So he wants to sleep, but he doesn't want to go to sleep.
Mm.
So I'm a little sleep deprived. I apologize, but if I fall asleep,
It sounds like me on a Tuesday. I want to sleep. Doesn't
Were
want to
you
go
at the
to sleep.
steakhouse on the Tuesday?
Yeah. Wish. No steakhouses in this province anymore.
No.
So, I mean, here's the next really interesting question. I mean, and this is a two-parter. You've got mortgage originations that are clearly down from 2021. Yep. You've got also a pretty significant amount of mortgages that are coming up for renewal in 2025, 2026. I think let's start with the renewal question, because
I love that question.
Oh man, what's the question? I haven't even asked it. What's the question? What's the
Oh,
question?
no, you got to ask. I just like talking about renewals right now because it's interesting.
Yeah,
in my opinion, at least.
I mean, first of all, like OSFI magically found this loophole that says you don't have to requalify under the stress test, which is hilarious. It's like this magic thing that, oh, we found it. It's like, don't you guys just make the rules? Can't you just say it and it's the thing?
They didn't find anything. They just made it up and said, nope, it was there before.
What I'm curious about is, so that's on insured mortgages. I want to see if they do the same thing for the rest of the mortgages, which is good, because what's important here is that they're going to give consumers the freedom to shop mortgages.
Yes.
Because the last thing you want to do, especially, and I have to say this, big banks, people need to understand that big banks are sales organizations.
Yes.
Their whole premise is to sell you something that leads to you buying another thing, which leads to you to buying another thing. And they're building a book of business around you that is profitable. So they're trying to get your bank account. They're trying to get your investments. They're trying to get your mortgage. And they're sales organizations. And I think what the nice thing about OSFI saying, these insured mortgages, you don't have to qualify at the stress test and all of these things, and there's no risk for another lender to take it on because they're insured, is a huge benefit to Canadians, because now you actually are going to have the ability to shop those mortgages and not just have to take whatever rate that the banks give you, which is something I was really concerned about, is that on renewal, these banks were going to be able to say, hey, too bad you're taking 8% because you can't go anywhere, and OSFI opened that back up. But I mean, what are you guys telling people with respect to renewals, especially, and this is an even better question, with respect to product? Because do you take a 2-year? Do you take a 5-year? Do you take a variable thinking that interest rates might go down? That's going to be interesting at the end when we talk about the rate predictions.
Yeah. I think it's when it comes to product, it's based on the client and how comfortable you are with risk, to be honest. I always tell people, if you want to take a 5-year fixed because you think rates are going to go way up and all this sort of stuff, and you're going to lose sleep at night in a 3-year fixed or a 5-year variable, take that 5-year fixed, because there's something to be said about quality of life. The big thing you want to look at is payment too. Can you afford those payments and all this sort of stuff? That being said, I mean, we do have some more clients now. The 5-year variable, if you're an insurable file, so 25-year amortization, the ability to get that back end insurance, prime minus 90. Some people are opting into that just because, I mean, we're at that high set of prime and people are thinking it's going to come back down. But it's also opened up some other things. And I know I kind of took a shot at those static variable payments for a bit, but even there, some of those are being opened up a bit more too, because with that static payment, if rates go up, your payment stays the same. So you're protected, right? So that's taking something like that would be the assumption that rates aren't going to go up much further, right? The other side of that coin is, as rates go down, your payment stays the same. So you put more towards principal. So you can kind of pay it off a little faster. So it's really, really dependent on the client themselves, what they're looking for, where they are in their life, and how much risk they're willing to take on when it comes to the mortgage and the term itself.
I think you brought it up earlier too, where I said I said this in a previous show where the most important economy is the individual's economy, right? So what's the most important thing is where you're at. How much money do you have coming into your household, and what are you spending your stuff on, right? And what do you have to do? And we've seen cycles like this before where things have gone, turned into a real shite show, and people get freaked out about it. But as long as you have some kind of a plan, it puts you in a good position. The guy that had a $500,000 mortgage 4 years and 54 months ago, and he was paying $2,400 a month because he was at 3%, and now he's going to be somewhere at 545. And when he renews it, his payment's going to go. And if he renews it with his existing amortization, he's $2,900. Now all of a sudden he's got up $600. Where does that money come from? So it's regrouping and saying, okay, what should we do, and where do we think rates are going? And that's a perfect graph because, if historically, if you took variable, it was the way to go. We were fixed rate guys years ago, right? And now it's really two things. One of the most important things is flexibility. So you go into something where you say, hey, do I go variable or fixed? If I go variable, I got flexibility. I can lock in if I have to. And also, if I go to pay it out down the road, I'm only going to pay 3 months interest to get out of it if I have to move to somebody else. So it's just I think that's where people have to understand you've got to have a little bit more flexibility than anything right now.
Yeah.
Do you know what the fastest growing segment of the mortgage market is right now with respect to type of mortgage and type of rate is? Variables.
Yeah.
People are
I believe
picking
it.
variables again. Now,
100%.
I still am a big believer. I always will be a big believer. And you take the lowest rate you can get at the time that you get the mortgage, which variable is not the option right now. But here's the thing: the reason why people are choosing variable rates is because they believe that they can time the market. So here's the thing: like they think rates are going to go down, so they're going to take a variable because then they're going to get the lower interest rates. And stay till the end because the predictions again are really interesting. But here's the problem with this whole line of thinking is the whole real estate industry, whether it's choosing a mortgage, fixed or variable, or whether it's buying a house, this whole conversation has turned into a day trading conversation. People are having the conversation around what's going to happen in a year to 2 to 3 years, and they're making decisions based on what's going to happen the next year to 2 to 3 years. And this is literally the equivalent of day trading stocks. A 1 to 2 year time horizon is a single day time horizon equivalent in trading stocks. And that's where things get really dangerous because if you're making those decisions based on the short term, the chances of being successful over the long term and constantly trying to time the market and be wrong are severe, right?
Yep. And that's something I tell any client I have that talks about like timing the market and stuff like that. I've had a number of clients ask me, "Oh, well, when should I do this? And when's this going to happen?" These sort of questions. And I it's impossible, man. Timing the market is it's flipping impossible. And
I mean,
I'd
even
say
when the
that from
guy who tells
experience.
you, even when the guy tells you, the guy who controls interest rates tells you it's going to be low, they're going to be low into 2023 and
Yeah, and then they
2024.
go up.
And then you're like, oh, well, then I should be able to time the market and take something out till 2024. And then it's like, oh, yeah, he was wrong. And
Yeah,
he gets to
sorry
make the
about that.
call, right? So,
He just changed his mind. That's all he did. He just changed his mind.
It's kind of like Osfi and their new rule. He just found it.
yeah.
But it's funny. I use myself as an example. So I've been a mortgage broker for over 12 years. My dad, who's my mentor, has been doing it for over 30. I bought a house. I took a variable. Got married during COVID, so couldn't go away on a honeymoon or anything like that. Had a belated honeymoon. And by the time I got back from my little 2-week honeymoon, the interest rate, my lock-in rate went from like, low threes to over 5% in 2 weeks. And like, I work in this industry and I couldn't time the market. And I was off because I had 2 weeks to lock in. Like, it's timing the market. If you think you're going to time the market and make bank, my recommendation to someone like that is if you really want to try it, go ahead, but don't put all your eggs in one basket.
People get caught up too. If you go back to those slides from Toronto and the condo marketplace and what's going on, because we know guys that have bought pre-sales and they're just closing on them now and they're going, oh, wish we'd have done that. Like we get caught up in the hype. And like in our little area here now, they're building condos like crazy, but they're not selling them, they're renting them. Yeah. And financing for multifamily is really inexpensive, and there's a shortage of it. And now they're talking about rent controls and everything else. Like it's the whole thing comes back to your personal budget, figuring out what you can spend per month and where you're spending your money. And when it's tight, tighten up. When it's okay, spend a little bit more, but still, you got to save for that rainy day in rainy day in retirement. And that's what people are doing right now.
100%.
Yeah.
I agree with you. Nick Baker here asked this question: will the banks lower rates and save mortgage holders who took out loans with cheap interest rates in 2020 and 2021? What do you guys think?
What do you
So
think, Greg?
we get the question asked all the time. Like, I went through numbers with two people today and yesterday where, they're coming up in July and August, right? The same thing. And, they're under 3%. And what do you want to do? Like, and where do you think rates are going? And everybody seems to think that rates are going to drop. So, you give them some options and say, and the beauty of giving them options like a CMO or whatever, you can show them and highlight and let them make the decisions now. And that's the beauty of our job now is giving people options and not making decisions for them, because that's not our job.
So let me ask you this: what was the decision that they made in that scenario?
The one customer is going to go variable with the VERM so that their payments
Pay
are
a way
structured.
higher interest rate.
Yeah,
Yes.
yeah, but they believe that rates are going to drop. So I'm not going to talk them out of that. We have another customer who only has a 12-year amortization left on their mortgage, and they've been following the payments up with a variable rate. And by the time they figured out what they were doing, now they can go into a fixed rate and drop it down to like 9 years. So at the end of 5 years, they only have 4 years left. So just different situations. We have other people now who are going, hey, listen, based on today's market, I don't give a crap if I ever pay the house off. So they're doing other stuff. And you've got, we have more and more reverse mortgage products coming out of the market than we ever have.
Yeah.
When I started doing this, we had maybe one. Now we have like
Yeah.
4, 5, 6. Now we got a couple more coming out. So there's always an option for people, right?
Yeah.
Well, and I think when you talk about the banks lowering rates to protect people, there's a couple of different things you want to look at with that too. Is why have rates gone up? Why has prime gone up in the overnight rates with Bank of Canada to combat inflation? At the end of the day, the Bank of Canada has a job to do, and in my opinion, until inflation is tamed and back to where they want it to be, they'll keep the rates high. It's just my thought process behind it. They are more than willing to put us in pain to save us from, an inflation rate of 8-10% per year. Because if our inflation increases that drastically, we're screwed. So until that inflation goes down, until they can sort of get a handle on that, to say with certainty that, rates are going to go down. Anyone that looks at you and says, rates are going to go down or rates are going to go up, I guarantee it. You can't guarantee it. The only person that can control that is the Bank of Canada, which isn't technically a person. But
so to answer next question, is the bank going to lower rates to make sure people are okay? I don't think they're going to do that. Because
it has nothing to do with the people.
Whether it's a bank or a MIC, you got to answer to your shareholders.
Yep.
Right. So they're not out there to lose money. So, and then how when we first started in this business, and Nolan, you've been doing it a while too. We used to watch the 5-year bonds all the time to find out. Every day we were watching the bonds, see where rates. There you go. Yeah.
Oh, speaking of which,
and I just pulled it up 3618 right now, so it's dropped a little bit, right? So that's what we watch, and that's what drove our 5-year funds, right? So, and then 8 times a year is when the bank, when the Bank of Canada meets, and that's when we see what happens to our overnight rate, which affects our prime lending rate, and that affects everything right up to our variable rate mortgages. So. And I think people now are starting to watch this stuff. So the media is starting to show them and educate people on what's going on. So, they're not in the business to drop rates to make sure that we're okay. Yeah. But they also, Scotiabank's putting $1.35 billion off to the side for what reason?
Yeah. And that's a pretty valid point. Like they're expecting there to be pain. And with respect, and I think you hit the nail on the head. The chartered banks aren't going to lower rates to save people. They're going to do what's best for the bank. And then the Bank of Canada might start lowering interest rates if there's a whole lot of pain felt, but there's going to be pain felt before they lower the rates.
Absolutely,
so
there will be.
The pain's going to come first before they lower them, which means there's going to be a window of people that are going to feel that pain. And the thing that you need to be thinking about is, how do I make sure that if I get caught in that window, that I'm going to be okay financially and that I'm set and I'm not going to lose my house. And then what's the strategy from that perspective? And my big fear is that all these people who are picking variable rate mortgages and picking 2 or 3 year mortgages, thinking that interest rates are going to go down, are actually lining themselves up with the potential big pain timing that could come if things don't go as expected, right? Oh, interest rates have to go down 200 basis points. Well, what if they don't? What if everyone's wrong like they were back in 2021 and they go the other direction, which, by the way, is very possible. And Danny B on here also points out that it all depends on what the U.S. Fed does. It doesn't
Absolutely.
all depend on what the U.S. Fed does, but the U.S. Fed is like this additional component to our
Yes.
monetary policy that is definitely something that has a major effect, right?
Who was it that was saying, like, when it comes to the policy rate with the feds and our overnight rates, there was a cap of like 2% difference, where if they go up past that 2% and we're 2% lower, we kind of have to follow. I can't remember where I heard that, but like I remember hearing
Yeah.
that, and the validity behind it, I guess it kind of makes sense to me, but it's definitely something to keep tabs on because our economies are so tied together.
I just happen to know a little bit about that from my education, so I can explain that. So basically what happens, to make it really simple, is when you look at these interest rates, it's just like anything else. Money flocks to where there's a higher interest rate. So if you are looking at TD and Scotiabank right now and going, TD has a higher dividend, you're probably going to invest there rather than investing in Scotiabank, who just reported really big loan loss provisions. Same thing with interest rates. If the US interest rate goes up higher than ours, then money flocks to the US, and as a result, the value of their dollar goes up and the value of our dollar goes down, and then that has an overall effect on the economy. Now, from an export standpoint, that makes our goods more valuable because they're cheaper, but from an internal perspective, everything in Canada goes up in cost, which leads to inflation, which leads to
Higher
us having to
rates.
follow what the US does. So that's like
Yeah.
the really simple explanation of it. And and that's why we have to pay attention to what's going on there. Ultimately, though, the Bank of Canada will do what they have to do in Canada to keep inflation low, which means if there's a divergence between the two central banks, it could just be nastier if the two economies aren't moving in the same direction for Canada than it
Hmm.
is for the US. Would you rather take $100 US bill or $100 Canadian bill in your pocket? Um, that's pretty. That's
That's a
Danny
good
B is
question.
asking that question.
I'd like
Um,
a 50 US and a 50 Canadian. That way you split the difference.
I think what he's getting at is that the US dollar is worth way more,
Yeah.
It is.
and again, that comes down to
I
those
mean, hear
interest
me
rates.
out. I would definitely take the $100 US, but then I would convert it to Canadian and then spend it that way. But that's just cash flow.
Exactly,
But
exactly.
it's funny,
That's a
one
good
of the
question, though. I like that.
we keep coming back to basics again, where one of your favorite guys, David Chilton, his first book and his second one, and the second one was good, and we talked about how people can save money. Like if you make $1,000 a month, you can, you spend it. If you make 10 grand a month, you spend it. So the difference between someone who makes $5,500 a month and 6 grand a month is $500. But can you save the extra $500? If
Yeah.
you really clean up your stuff and your process, you can. And that's the thing. So that when you go through times like this and you've got a bit of a contingency planned, or you've got a bit of a nest egg, then you're not buggered up. And I think that's the key, is that people have to get back to their own basic solutions on how
Yeah.
to make sure they got something stashed on the side.
Well, I
Yeah.
think a lot of people left behind the entire budgeting mentality too. Like the amount of people I know and who I've worked with who, you ask them, it's like, how much do you spend per month? What's your actual positive cash flow on a monthly basis? They have no idea. Well, can you open something up and find out? No, I can't. What about annually? Do you know annually? No. And, I mean, it goes back to that sort of paying yourself first mentality, where it's like, okay, I'm going to put this amount of money away in my savings account every single month, and that's going to build up to X amount of dollars at the end of the year, and so on and so forth, and it grows from there. And one of the big things we talk to our customers about is saving for a rainy day and retirement, paying off your debts, and having fun. And it's you have to find the balance between those three things. If you don't, you're kind of screwed. And I think this is a prime example of where that balance can become very important. And once again, I use myself as an example. I have a variable rate mortgage that started off at 1.8%. I'm up at 6%. And if I didn't do my budgeting, if I didn't use the tools and it's tools we provide to every single customer. If you talk to us, here's a budget sheet. Here's tools that can help you do this. But if I didn't do that, me and my wife would be screwed. Like our interest rates have gone up. We've had a baby. I took a month off work to hang out with my baby. Like our costs have gone up dramatically. But yeah, I left Greg on his own. He was very disappointed in me. But
I'm old. I can't do this anymore. I'm old.
He doesn't look it though. That's the great thing. I'll look young till the day I die. It's gonna be great. But if you budget and if you do a budget and work towards it and work with the money you have coming in and keep tabs on things and live within your means, you can survive this stuff.
Sure
you can. You know, it just takes a little extra effort.
Totally. So moving on to another topic here, and this is the one that we've kind of been alluding to right from the beginning of this live. Some really interesting predictions on what is going to happen with interest rates. First one here is from the economy from Bloomberg, and an economist is suggesting that there's going to need to be 200 basis points of cuts in 2024. Another one from Rosenberg. They might actually be citing the same economists here. It might be Rosenberg on both of these, but oh no, this one's bigger.
3%.
David Rosenberg suggesting that they need more than 3 percentage points to avoid a severe recession. Now, one caveat about Rosenberg, he does claim, and I think he did predict the meltdown in 2008. He's also predicted a lot of other meltdowns that didn't happen. Very good economist, also very good at getting headlines, which means you say controversial stuff to get on TV. So this is interesting because you've got multiple economists saying that there's going to have to be severe interest rate cuts in order to prevent whatever's coming from coming. What's your guys' thoughts? What's your predictions on where interest rates are going to go? Won't hold you to this. This is YouTube. and I also have to say, before you guys go into this is a YouTube live video from 3 mortgage brokers who are talking about interest rates. This is not independent financial advice. We have not spoken to you. We have not figured out what your situation is. Do not make any sort of mortgage moves based on what was said here. Talk to a professional. But with all that said, the disclaimers, don't choose variable if you don't know what kind of product you're choosing. All the disclaimers. What do you guys think is going to happen? Where do you think we're going from an interest rate perspective?
I love these headlines. Now, to start this off, I got a question for both of you. Do you think they're saying this based on the fact that they're terrified of the upcoming renewals because there's so many coming up in the next 1 to 3 years?
Yeah, I think they don't care because they've already moved the rates up, so they really don't give a crap.
Yeah, but I mean, you got the guy who's got a $600,000 mortgage who's at let's say 3%, 3.5%, and he's going to come up for renewal at 6.5%. That's a big jump, or like 5, let's say 589 to 6.5%. That's a big jump. That's a lot. And I mean, if you look at the amount of mortgages coming up for renewal, I think a lot of people and I think a lot of economists are looking at that and they're kind of scared of it in a way because, I mean, we saw it. And once again, go back to 2007 in the United States where people had mortgages with low rates that went through the roof and they walked into the bank and said, here's the keys, take my house. I don't care. And we saw what happened there. I think, the question is that what economists are scared of? Are they worried that what happened in 2007 in the United States, are they scared that that's going to happen now?
It's kind of crummy because the same guys that said that they were going to keep rates down to the middle of 2024 now, are listening to the other economists. And Benjamin Tall now thinks that Q2, we're going to start seeing rates drop again, the overnight rate drop again. So, and they're talking about it, the same thing. He's not coming up with a percentage point amount. He's just saying that they're going to start dropping. So
I think that's a good way of doing it too. Like I think rates could go down, but I'm not going to say they're going to go down 2 or 3% in 2024 because I don't think they're going to. If I'm being honest,
because then my line of credit would go down by 2 to 3%. I'd be happy in the plan, right? But
I'm still at a variable. They want to drop by 3%. Heck yes, I'll take that every day. Come on, bring it on, bring it. But I can't see it happening.
Well, I think the bond market's definitely predicting that something's going to happen. You see the rates a month ago to now. I mean, that's a pretty big drop. We were up around like almost 4.4, if I remember correctly, and now we're down almost 0.8.
We're down 80 basis points,
right. So it's like the market's going okay. We're nearing the end of this. The question is how much, and I think you're right. Like if there's a lot of pain, if there's a lot of people that have their payments increase and that puts a pretty big zap on the economy because we haven't really felt the interest rates increases across all of those people who still have those 5-year fixed mortgages and those fixed rate variables. But if
Yeah.
that starts to play out more and that shrinks the amount of money in the economy significantly really quickly, then they're gonna potentially come down. But it could go the other way too,
Yeah.
right?
Well,
So
and I think there again, when your payment goes up, if you're $500,000 mortgage and it comes up for renewal and you're 437 owing after 5 years, and your payments are going up $600,
Yeah.
and you weren't saving anything before, where the hell is that money going to come from? So
From
all
a
of a sudden,
budgeting tool.
yeah, we're going to be, we're not buying the new car, we're not putting money
Yeah.
into RESPs or RSPs and the stuff that we were putting it in before. So now we have to be really careful with our cash flow.
Yeah. I think
And-
one of the things too that, sorry, I cut you off there. Carry on, Greg.
And I just think that, is this a short-term thing? I think you just got to have the flexibility. You got to have a lot of
pivot.
flexibility, and you got to have a plan. And so there again, as soon as if things were to change again, and you can do things that allow you to change quickly, that's the most important aspect.
And I think the plan is right, because here's the thing: if what David Rosenberg is saying, and we see a 3% decline in interest rates, that's awesome. That's the best case scenario. But do not use those predictions to make your decisions. The way you have to make your decisions on buying a house, getting a mortgage, all of that stuff right now, renewing your mortgage, selecting your term, is by looking at what the worst case scenario is and making sure that you're covered for that. And then if what Rosenberg says is true, then you win. And that's good news. But don't get caught up in these headlines and go, well, they say this, so I should be good, and then get way behind the 8 ball.
Yeah, when I look at stuff like that, I really do. And it's an old classic phrase, but you hope for the best and you plan for the worst, honestly. And when you're talking about hundreds of thousands of dollars when it comes to an investment such as real estate with hundreds of thousands of dollars debt, you got to be prepped for stuff for the proverbial word to hit the fan, shall we say? Because it can happen.
Totally. So let me ask you this to kind of round out the conversation here as we approach 53 minutes. Thank you to everyone who chimed in here on the comment section. Danny B, Green Bean, Nick Baker. I want to call you Nick Barker because I have a buddy named Nick Barker. Danny B, Reiko. Thanks everyone for joining us. I'm going to end with this question, guys. If you had to give somebody a piece of advice on buying a home or getting a mortgage going into 2024 in under 5 words, I know that's hard for both of you. It's hard for me too. But in under 5 words, what would be the piece of advice that you would give? And I'm going to take the easy one for you guys because the ones that you guys tend to say is budget, 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 budget. If it's not that, what would be the advice you're going to give?
You need a place to live.
Yeah.
That's number one. So
that's
number
6
2,
words.
Yeah, you need place to live. All right, sorry, but you need place to live. And with that, it's got to fit within what you're doing. So and people always forget. I know this is more than 5 words, but if you're going to rent for $3,000 a month and you're going to pay a mortgage for $4,000 a month, you know that $1,500 of that $4,000 is going into your principal every month. So you're saving. Yeah. So and if the house never went up in value and you paid it off in 25 years, you could piss away $3,000 a month in rent, or you could have a house paid for.
Yeah.
So,
well, I think we did an episode about that too, where we showed the net worth between renting forever and owning a house, and it's a big difference.
Miles, what's your 5 words?
I can't do it in 5 words, man. I love talking.
I know.
I'm like the thing that doesn't shut up. Can I have 6?
Yeah.
Plan for the best, hope for the worst. Or wait, sorry.
Hope for the best, plan for the worst.
Hope for the best, plan for the worst. Never mind. Scratch that. Can we edit this? Oh, wait, it's live.
The number of words screwed you up there. Sorry, man.
It did. Yeah, you really caught me off guard. Like I said, you can't limit my words. I get confused.
Our whole thing is always to pay off your debts, plan for a rainy day retirement, and have some fun. So you got to balance, right? And I think that's the key at the end of the day. If you've got food in the fridge and a roof over your head, and you know that when you retire, you don't have to change your lifestyle too much. You're living the dream.
So here's my 5 words. Don't be afraid. Be prepared.
Attaboy. That's awesome.
I like that.
I
really like that. Except you stole our budget. So you got 2.
I didn't steal it. I just took it away.
Come on.
That's all.
What the hell?
guys are
What the heck?
predictable. I had to take it away. Make you
I
say
You know
love
something.
what? And two, I mean, one thing if times do get tough, you can always rely on the really simple thing.
Your
Candy
parent.
and lunch meat, baby.
Your
Candy
parent.
and lunch meat.
I love it. Funny. Well, thanks, guys. Thanks for joining me here. We are going to close out on that note. Thank you, everyone, for joining us, and we'll see you on the next one.
Thanks
Thanks
Nolan.
for having us. Thanks, Nolan.